Hello and welcome to this session in which we would look at an example. In this example, we're going to differentiate between different funds. So basically, when we have transactions, the transaction might affect more than one governmental fund. So this is an example just to show you how things are recorded in various governmental funds. So this is a practice for the journal entries and a practice to show you how things are recorded in different funds. So let's take a look at this example. So this, we're going to call this a government organization rather than not-for-profit. They maintain two funds, a general fund for operation. So obviously you'll always have a general fund, and a building fund to accumulate resources for the new building. So we're dealing with two funds. And basically what we're looking here is this. So in this example, we're limiting ourselves to two funds. So to make it easier for you, they have a general fund and they have a capital project fund because they're building a new building. And remember, new buildings goes into the capital project funds. So we only have two funds. So we have a series of transaction, 1, 2, 3, 4, 5 transaction, and we're going to prepare the journal entries to record these transactions. So that's the purpose of this session, is to show you how to record the journal entries, another practice for you, as well as showing you in which fund does it go, in which fund does this transaction affect, which fund. So the government receives cash contribution of $200,000, of which $40,000 were restricted for the acquisition of the new building. So someone gave the government $200,000. Well, $40,000 is restricted for the building, and $160,000 obviously is not restricted. So here we go. We have two entries basically. We're going to debit cash for $160,000, credit contribution revenue or some sort of a revenue, $160,000. And since this amount is not restricted, this amount goes into the general fund. Now also we received $40,000 in cash because we received total of $200,000, and that cash, remember, it was also a contribution, so this is going to be called contribution revenue, $40,000. But remember, this $40,000 is restricted to the building, therefore it's going to be put into the capital project fund, because whoever gave us this money, they said you could use $160,000 for whatever you would like to, which is the general fund for the general operation, and the other $40,000 I want to contribute this money to the building, therefore we have a capital project fund. So this is the first transaction. Second transaction, we incurred $130,000 of operating cost, of which $120,000 is paid in cash. So $120,000 is paid in cash, and it's okay, $120,000 is paid in cash. So now what we do is we debit. Let's start with the credit. We're going to credit cash. We're going to credit cash $120,000. We're going to debit. What are we going to debit? We're going to debit operating expenditure. Remember, we don't call it expenses. We're going to call it operating expenditure. Remember, since we're using fund accounting, we use operating expenditure. How much are we going to debit operating expenditure? $130,000. Now you might be asking, why $130,000 and not only $120,000? Because we only paid $120,000. Because remember, in the prior session we only recorded cash. But remember, in fund accounting, we're using here modified. And if you don't know what this is, you can go back and view the other session. Modified accrual. In modified accrual, we account for two things. We account for cash and short-term assets and short-term liabilities. So notice we can account for accounts payable because we did not pay $10,000 of the operating cost. But remember, accounts payable is a short-term liability. Now if we finance this transaction using long-term, let's assume we finance something by long-term, then we don't have a notes payable. We will not have. Then under those circumstances, we will have operating expenditure $120,000 or whatever we spent, $120,000, cash $120,000. But this transaction involves a current liability, AP, which is we do record current liabilities. So this is what this transaction looks like. Earn $3,000 interest. The entire amount is received in cash, so we have cash on resources restricted to the acquisition of the new building. So this money is before we proceed, this is a general fund, because in the general fund you account for the general operating. So this is the general fund. So we earned $3,000 in cash from the account that was restricted for the acquisition of the building. So transaction 3, We received cash, that's easy. We debit cash, $3,000. We received cash for interest revenue. We have interest revenue, $3,000. That's so far so good. Now we need to know which fund. This is going to go into the capital project fund, because this fund is coming, the interest revenue is coming from the capital project fund 4. Now we could also earn interest from the general fund, but it's telling us for the general fund 4. It transferred $17,000 from the operating fund to the new building fund. So here's what happened. The building fund, the capital project fund, they needed some money. So we're going to transfer money out of the general fund and into the building fund. So here's what's going to happen here. Here we're going to have 2 journal entries. Why 2 journal entries? One entry to move the money out of one fund, and one entry to accept the money in the other fund. So let's start with the general fund. The general fund transferred money out. So notice here we're going to have 2 entries. So let's start with the general fund. The general fund, they're going to credit cash. They're going to credit cash, $17,000. And they are going to debit an account called something called transfer out. So they transferred out $17,000. Okay, so they transferred out $17,000. That's the general fund. That's in the general fund. Now, we're not done. What happened is the capital project fund received the money, so they're going to debit cash, $17,000, because they received the cash, and they're going to credit an account called transferred in $17,000. Now you might be asking, what is transferred in and what is transferred out? What is these account are? Remember, we talked about other financing sources or other finances uses. That's what they are. Other financing sources and other finances uses. So for the building, that's a finance source. For the capital project fund, that's a finance source. And for the general fund, that's a other finances uses. We use the cash. So notice we needed 2 entries, because when we have an interfunded transactions, we're going to have 2 entries to account for. The last transaction, we paid $12,000 in fees, accounted for as expenses to an architect to draw up the plan for the new building. So those are accounted for. Notice it says here as an expense. So they chose to account for them as an expense. They did not choose to account for them as part of the building. So remember this matters, because if they chose to account for them as an expense, then what's going to happen? They are considered expenditure. They are considered expenditure in the general fund. In the general fund, they are considered expenditure. So what's going to happen is this. We're going to debit. You can call it architect expenditure. You can call it building expenditure. But let's call it architect expenditure to keep separating it from the business. Architect expenditure, $12,000, and we're gonna credit cash $12,000. And this is, as we said, it's gonna go into the general fund. And hopefully this exercise will help you reinforce what you did. And my son just walked into the room, so study hard and good luck.